So welcome everyone. Thank you for taking the time to join us for our live planning webinar here. The idea behind this is to focus more on some of the strategies and things that we can control when it comes to our finances and investments. Clearly, there's been a ton of noise in the market this year, obviously with the impact that the virus has had in the U.S. and around the world, and also with the oil negotiations and that oil prices falling through the floor too. So we wanted to host something to talk less about those things and economic things and focus more on the things that are within our control. So it's myself, Rob D'Angelo, for those that don't know me, and also my two colleagues, Greg Kammerer and Rolf. They're also two other financial advisors for us here at Altrius. And our agenda is pretty straightforward. Chris is going to take us through some updates as regarding financial planning for retirement plans and retirement strategies, things that came out of the CARES Act, which was the stimulus bill that passed at the end of March. Greg then will take us through some strategies when it comes to mortgage refinancing, especially in this low interest rate environment as they've only gotten lower. And then I'll go last, and I'll just review some of the questions that we are getting from our clients when it comes to financial planning. And then we will leave some time for Q&A as well. But before we get into all of that, probably a good idea, we don't all know each other on the call here. The three of us, me, Greg, and Chris, figure we'll just do a brief intro and then we'll kick into it. So again, for those that don't know me, my name is Rob D'Angelo, financial advisor here at Altrius. I moved down to the New Bern branch, the New Bern office from New Jersey about 10 months ago. So I was born and raised up north, and I'm a very happy Southerner now. I've been in wealth management for a little over 10 years, studied finance at Virginia Tech, go Hokies, and loving my time here in New Bern, and just, happy to be here. And again, thanks everyone for the time. Chris, you're on mute.
All right, well, maybe I'll go then while Chris is getting the mute issues sorted. So my name's Greg Kammerer. I joined the firm back in January. I've been in the private finance space for a little bit more than a decade. I'm here in New Jersey with Jim Russo. I went to Monmouth University where I ran track, and I also went to Seton Hall Law School. So I can bring a little bit of some more estate planning and some, legal answers to a degree to some of our clients to help them think out some more strategic parts of their planning.
Still not connected, Greg. Chris, sorry.
Do you need to unmute him?
Nope.
Finally, we're on.
That's all right. We're just getting started. You haven't missed anything. We just quick introduction. Having some, Chris, I just sent you a message with the dial in that way, audio.
I don't know.
Because it said the address was invalid.
Let's see. Mm-hmm.
It looks like Chris's icon shows that but his mic it doesn't show up.
Yep, he's dialing on for audio. He should be on in a second.
Example, last thing I would say is, for Michael Flynn, somebody who I knew during the Bush administration, I am glad.
Is that better? Do you hear me?
We gotcha.
All right, sorry about that, everybody. A little technological snafu there. First, Rolf with Altrius in the Raleigh office. Work with our clients from really Raleigh, west of I-95 in North South Carolina. I joined Altrius about 5 years ago. Had been in Chicago for about a decade working with clients on the financial advisory side, and really happy with the move down to North Carolina here. Thanks for joining us.
All right, great. Thanks, guys. So with that, we'll kick off the formal presentation. So I will hand it off to Chris to take us through some retirement strategies.
Thanks, Rob. I think part of what we wanted to cover tonight, and there's been a lot of changes on the 401k and IRA side as it relates to both the Secure Act that was passed at the end of 2019, and then the CARES Act, which Robin mentioned was the COVID-19 Relief Act. So there's been a lot of changes that have happened in the last 4 or 5 months here. We've communicated some of this via email and in talking to clients one-on-one, but just thought it was worth, since there's been so many changes, to reiterate what's really gone on here in the last couple of months. And then at Altrius, 47% of our client assets are in retirement accounts. So again, it's certainly pertinent here with some of these changes. Can you click through? There we go. So one thing that happened, this happened in the Secure Act at the end of the year. Congress nudged out the RMD age to age 72. It had been 70 and a half. So they nudged that out just a little bit, which for some people that gives them a 2-year extra window. Some people gives them a 1-year window to delay their required minimum distribution if they want. The 59 and a half age is still the same. So if you want to start taking out of your IRA without penalty, it's still 59 and a half. That age has not changed. Big change this year with the Secure Act, the CARES Act that just got passed. RMDs for this year have been waived. That's a pretty big deal here. Some clients have completely stopped taking their RMD. If you still need income and this is your main account, you still take it, no problem. But if you don't need it and you still need income, some clients are taking it out of maybe a joint account or a trust account and not taking the minimum distribution. There is precedence for this. Congress did this in 2009 as well. They did waive RMDs for that year coming out of the financial crisis. So this is something they've done before. But again, RMDs waived for the years is a pretty big deal. This goes back to the first point here. So when they nudged out the age of your RMD, that's a revenue loser for the government. And to make up some of that revenue, they condensed when you can take out of an inherited IRA. And this is for people who have passed away 2020 going forward. So if you have an inherited IRA already, there's no change. But going forward, this is a pretty big change here. First of all, though, there's no change for a spouse. If I pass away, my wife Lori would get my retirement accounts, and she would have the same withdrawal rules. So for a spouse, there's no change. But for kids, grandkids, et cetera, who may be beneficiaries, this could be a pretty large change. And some things that have happened here, prior you could stretch out an inherited IRA over your own lifetime. So if I, roughly 40 years old, inherited an IRA, I could take withdrawals over maybe 35 years. Now it's over 10 years. So it's a much more condensed period. You don't have an amount you have to take out every year. Again, this is for kids and grandkids out there. Good thing to kind of cover with them. But if it's a larger IRA, maybe I'm inheriting $1 million in an IRA, that can have some pretty significant impact tax-wise for somebody, based on income and income brackets. So that's a pretty big change. You know, with this, it's always important to analyze your own family situation. There are some select cases where you can still stretch an inherited IRA, but it's very minimal. So it's always good to review your beneficiaries and make sure it's appropriate. But this stretch, it will accelerate tax payments for people who are inheriting particularly larger IRAs. Another change for clients who are working is we're all living longer. People are working longer. And there's now no age limit for IRA contributions. Before it was age 70 and a half. Now, if you're 75 and still working, or even part-time, you can contribute to an IRA or a Roth IRA, depending on your income. So that's a change. The other change that happened on the contributions is, as you may know and I'll know, is taxes have been pushed out to July 15th. So for 2019, your contribution, you have until July 15th to make a contribution for 2019. And then the other thing some folks are doing right now is they're accelerating their 2020 contribution because the market's down here. It may make sense to kind of accelerate your 2020 contribution if you want to. But again, no age limit on contributions anymore. I was just looking at some numbers from Goldman Sachs here. So tomorrow the job numbers come out, and they're going to be dire. I mean, they're going to be brutal numbers coming out. The consensus is for 22 million people that have lost their job the last month in April. Goldman Sachs is predicting 24 million. So it's a big number. A lot of people are struggling. This may be a friend asked a question. This may be a daughter or a niece asked this question. I've had a couple questions on this issue when it comes to hardship withdrawals or taking money out of an IRA prior to being 59 and a half. What has been done here is there's no 10% penalty, and this was part of the CARES Act that got passed at the end of March. If you don't pay the money back, you would owe taxes on it. But what they've done is, in addition to no penalty, they're giving people 3 years to pay any money back, and they would consider it a rollover. So if you took $40,000 out now to bridge losing a job, a few months down the road, you get your job back, and you're in a position to pay it back, you can. You would avoid the penalty, you would avoid taxes, it would just be viewed as a rollover. So that's important. If you're not going to pay it back, they're giving you 3 years to pay taxes on. So they have tried to help some people if you're in a bind. Again, maybe you know somebody. I was on the phone with a friend today who's completely out of work. So it is a very tough time out there for a lot of folks. So I thought that was pertinent to bring up that change there in terms of hardship withdrawals. And then one planning idea that we wanted to bring up here, and some clients have already executed on this and done this. In some of these cases, it's always, in particularly a Roth IRA conversion, it's always good to talk to your CPA, talk to your advisor. Your CPA may give you guidance about, what makes the most sense as well. But a Roth conversion is the process of moving money from your, say, traditional IRA to a Roth IRA. And with clients at Altrius, 95% of retirement assets at Altrius are in pre-tax money, meaning they'll have to pay taxes at some point, and only 5% are in Roth. So we have a lot of clients out there with money in a traditional type IRA. And there's certainly some advantages right now to at least considering a Roth conversion and what that may mean. We'll cover some of the benefits here. With a traditional IRA, you have tax deferred growth. With a Roth, it's tax free. The caveat, again, we'll get to the negative. The caveat is to move money from a traditional to a Roth, that's a tax bill that comes due. But with a Roth, once it's in there, it grows tax free, and then your heirs, you pass away, and in 20 years, your heirs then have another 10 years of potentially tax-free growth until they have to touch that account. So it can extend that pretty nicely for beneficiaries as well. With a Roth, you don't have a required minimum distribution. You do with a traditional IRA. Again, at age 72, Uncle Sam knocks on the door and says, "Give me my share." They do not with a Roth. So you do not have that annual required distribution. I was looking at some numbers earlier this week in terms of taxes. In 2000, the first $100,000 of your income was taxed at 22%. Today, the first $100,000 of your income is 13.5%. So taxes have fallen a lot in the last 20 years, almost by 50%. Again, we don't know the future. We don't know where taxes are going to be in 10, 20 years from now. I bet you if you took a poll here, people think taxes are going to be higher in the future, not lower. So it's a time to, by doing a conversion, you're paying tax now when rates are potentially lower than they are in the future. And again, rates certainly have come down a lot the last couple of decades. We've all been through this last couple months. The market's down. It's starting to rally back here the last 6 weeks or so, but it's still down from where things were a year ago. In many cases, the start of the year. And with the conversion, you can, if you know you want to convert a certain amount, say $30,000, you can pick a particular stock or two to move, whether it's Apple or Starbucks. Starbucks is down 30% from its highs. Maybe that's a stock you'd move. Maybe it's a bond that's trading at 85 cents on the dollar that we think is going to come back to 100. Again, that appreciation, you're paying taxes at a lower value than what it may be in the future. So given things are down here this year, timing-wise, it could make sense there to consider the conversion. And for some folks here, incomes may be down. Maybe you've been furloughed. Maybe you're temporarily out of work. Maybe you're in that small window of you don't have an RMD or your RMD's been waived here. With that happening, you're at a period where you haven't started Social Security yet. Again, income may be higher in the future for you. So each situation and each person is different in their situation. But in some cases, if you're in a down income year, it could be a time to move some assets into a Roth IRA, realizing some additional income. And then, finally, on the Roth conversion idea, the main negative is no one likes to pay taxes. And you do have a tax bill that would come due in April. If I were to move $30,000 from my traditional IRA to my Roth, that $30,000 is ordinary income. I've got to have cash kind of ready in the bank to know I'm going to have maybe $10,000 that I'd owe in tax. So you want to have some extra cash to be ready for that a little higher tax bill. that's the main negative. People, you just don't like having to write that extra check or pay that extra amount to Uncle Sam. But again, given some of the positives above, it may make sense. And what I would say here to close is any questions on this, since it is so specific. Ask Greg, ask Rob, ask Jim, ask me, because it is such a specific situation here. But it's certainly, I think, a good time to consider for a lot of people this idea here of a Roth conversion.
Thanks, Chris. Nice job. I'd also say we aren't tax advisors. We can do a lot of the modeling. The software that we use, we can look at different Roth conversion scenarios. So if you or anyone that you know might be interested in that, that's something we could certainly help with. But you're also going to want to yourself or advise whoever is interested to consult their tax advisor as well before making any of these changes or implementing any of these strategies. So with that, I will we'll go on to Greg and talk about some refinancing ideas.
Great, thanks. So this is something that I thought would be interesting in the thought process of just thinking about individuals who may, still have a mortgage on their home, looking for ways that they may be able to take advantage of what's been happening in the marketplace and potentially save some money by looking at some different perspectives. So, Rob, if you want to click through just to put the rates in there for us, thanks. So this data comes from Freddie Mac and the St. Louis Fed. I kind of selected what rates were, starting in April of 1985 for both the 30-year on average and the 15-year on average. And you can see back in 1985, for some of you who may have been around and taking a look at mortgages of that standpoint, astronomically higher than what they are currently today, about a full 10% higher on a 30-year fixed on average. And they've slowly been coming down, relatively in those 10-year increments that we have here. Traditionally have been, around, 5 to 4% over the last, say, 10 to 15 years. But what I thought, is just interesting, and even my own personal situation, my wife and I, we just bought a house about 2 years ago. And the difference between the two different rates that we had just made a lot of sense for us to really do a refinance. And we were able to do some interesting things there to save some cash. So just to kind of show you again, right now, as you see in the chart, interest rates really are at an all-time low. Whether you're looking at a 30-year or a 15-year or, other type of instruments. So the next slide, if Rob, you can click over to that. This is really kind of a little bit of a case study that I wanted to just show to everyone. Again, everybody's situation is different. Perhaps this is, just something for you to talk to a friend about that they might want to think about, or kids or grandkids. And Rob, if you can just click through all the data too. This, to me, I think kind of shows you the flexibility that switching over to different mortgages could potentially provide you if you're in a situation, or a situation similar to this. So taking the data back from when we saw the original, average mortgage rate back in 2005, which was a little bit under 6% for a 30-year fixed. And assuming you bought a $500,000 home with a 20% down payment of $100,000, 15 years later, relatively, today, that initial loan balance would be about $283,000. Where, if you look in the first column that we have, you can continue paying, your entire interest. You still at that, 5.91% fixed. Your monthly payment's about, $2,300, just a little under $2,400, and your remaining interest to pay is, about $144,000. You could, in a situation based on what we saw with your switching over to the current 15-year fixed rate average, with really converting the rest of that remaining loan balance just to try to make things fair and even, you could reduce that monthly payment by about $400, reduce the amount of interest getting paid forward substantially, but there are generally additional fees that you need to pay in the sense when you're, doing your refinance. It's going to range depending, property taxes, where you live, and some other, just different fees that are associated with that. So similar to Chris's point, when you're making the conversion from your ordinary or your traditional IRA to your Roth, there will be another fee associated with that. So you can kind of see if you were to make that change from your initial 30-year loan to a 15-year fixed, that additional $6,000 fee, if you're thinking from the refinancing standpoint, will still take you a little bit more than a year to recoup those original costs and to really kind of break even. But if you look at the difference between the two remaining interest payments between the initial loan and the 15-year, you are saving somewhere in the neighborhood of about $80,000 of remaining interest. Further, if you wanted to say, okay, instead of switching to a 15-year fixed, and which was principally how much you would have on the initial loan, you switch to say a 20-year fix, so you're extending that term of your balance out about another 5 years. You will be paying more interest, obviously, but the nice part is you will be reducing that monthly payment. So if you're in a little bit more need of increasing that cash flow, you can see that it's about a $300 savings in relation to the 15-year fixed in this example, but it's also is about say $800 or so a month on the initial loan balance as well. Of course, you are increasing the amount of interest that you need to pay in comparison to that 15-year fixed. But again, it helps increase that cash flow going forward if that's a situation where you or somebody else that may be in need of. So just kind of really something to think about. Again, this may not be exactly for you. Certainly, I know in my personal family, a couple of my wife's uncles were close to paying off their home in about the next year or two, so it doesn't really make that much sense from their perspective to pursue a refinance. But where you have a larger balance and you can certainly save some cash going forward, you could see that there's the ability to really kind of do free up some cash flow and use that cash for some extra things as well that you might need to going forward. So just kind of a general overview. Again, everybody's situation is different. Similar to we're saying with your tax advisor, this is something that we could help you model out. But again, definitely would probably need to consult with your local mortgage broker just to make sure you understand all the terms and ramifications that could happen as well if you do go down this path.
Good stuff. Thanks, Greg. On to the last part here. So this has obviously been a crazy year. We saw the fastest top to bottom 35% drop in the U.S. market ever recorded, followed by the best U.S. market since 1987. So it goes without saying that it's been a roller coaster year. And when we get clients who call in, there's a lot of anxiety, a lot of confusion. People aren't unsure of things, and they don't even know the questions to ask most of the time. So we thought this would be a good opportunity to share with you some of the questions that clients have asked us, and just give a brief overview on how we respond to that. So number one, I think we've all gotten this, is has my income changed? And as you know, as being clients of ours, we do focus on income. So we've done a lot of change. We've made a lot of changes to the portfolio, being in this new environment since around mid-March. And what we've done on the income side is we've kept the yield relatively the same. So if you looked at the income yield on your portfolio in January and compared it to where it is today, we are still on average for our global income strategy, our diversified strategy, still generating about 5% of interest and dividends in that type of portfolio. So we've done what we feel is a good job making the portfolio resilient, so that income stays reliable. And as Jim has said a number of times, Altrius has been in business since 1997, so we've seen the stock market burst, we've seen the Great Recession, and now we just saw the fastest 35% drop ever recorded in the U.S. And even with those three things, none of our clients have ever had to go back to work, and we take great pride in that by being able to provide that steady stream of income for them. Another question, kind of similar to the income side, but am I withdrawing too much? Am I spending too much? There are a number of ways to answer that question. And what I think we've done in breaking down that answer to clients is first, reevaluate your household budget. That's where everything starts. If your expenses, if you need to withdraw in order to meet your expenses, then that's what you have to do. But in periods of stress like this, we do have a number of clients, even myself, I've definitely re-examined where all of my money is going on a monthly basis, and situations and things that I can cut back on, I certainly have done so. And I've talked to a number of clients who are doing the same thing as well. So that obviously helps on the withdrawals and the expense side. Anything that you can cut back, certainly cut back. But tying that into income too, the financial planning rule of thumb is for a sustainable spending rate on a portfolio, that percentage is about 4, maybe 4.5% as a sustainable spending rate. We produce a little bit more than that on the income side. So the way to think about withdrawals is, if you're only taking out the income that we're generating for you on an annual basis, in theory, you're not then having to touch any of your principal. So the income from dividends, it's paid on a set schedule, interest from bonds as well. If you're only taking the income, so about 5% of your portfolio a year, that should be sustainable for what our strategy is and for what your needs are. Gotten this question a few times too over the past few months. Should I reallocate my 401k? These are from clients who either have children, grandchildren who are working, or a number of our clients are still working as well and saving up for retirement. And every situation is different, but I think that question generates from people seeing what unfolded in March, seeing the S&P down from its highs about 35%, and wanting to know, do I need to do anything different when it comes to how I'm allocated? A lot of that depends on the person's individual situation, if they are, how high their risk tolerance is, what their time horizon is to retirement. If it's someone in their 50s who's in their prime earning years, it may be the case that they can reallocate, take advantage of lower values now, and perhaps invest a bit more, increase their allocation to stocks, being that they have a good income and they have a couple of decades to where they're going to need that money to spend in retirement. So they have the opportunity to possibly be a bit more aggressive. If it's someone who is a year, 3, 5 years out from retiring, it may be the case that they don't want to continue to have as much risk in their 401k as they have had up to this point. So there could be an opportunity to scale back and re-examine things and decrease their exposure to stocks so that they are more conservative in protecting that nest egg for whenever their retirement date is. But again, we can model a lot of these things, and it is so client specific, and everyone's situation is different. So if you have friends or family or yourself considering questions like this, certainly reach out to any one of us, and we'd be happy to have that conversation. Another good question here: should I make contribution to my children or my grandchildren's 529 college accounts? I'm going to repeat some things here. There's some common themes in this answer as there are for the reallocating 401k. A lot of that has to do with time horizon and the age of the child. Obviously, the longer that money is in the 529 account, the younger that child is, the longer time horizon that money has to grow, makes a contribution now a lot more powerful, especially when you factor in using any money in the future for college. That's all tax-free. So that's a pretty powerful thing too. And you know, if it's a child that's younger, I have 2 young kids. My son's 3.5, my daughter's 1.5. We've certainly taken the opportunity to add some money to their college accounts. Typically, the way those work is that they are more aggressive, more allocated towards stocks the younger the child is. And as the child grows and gets closer to the age of attending college, becoming a lot more conservative, because what you don't want to happen is a situation like what just unfolded, where you have a pot of money saved up. Say it's your granddaughter, your grandson, your son or daughter, it's their first year of college, and say you've been able to save, you know, $100,000. It's still heavily invested in stocks. The market drops 35%, and now you're looking at, you know, 70 grand in that account when you had 100 grand, because you're still heavily invested in stocks there. So naturally, those accounts, you want them to be more conservative as the child enters college. But right now, taking an opportunity to evaluate your individual situation, it could certainly make sense to take advantage of the market drop and make contributions at decreased valuations. And lastly, we've gotten this from a few clients too. Do I need to make changes to my estate plan? And I'll tie it back into, you know, some of the remarks Chris made in talking about the IRA changes. It's, I think, always a good time to reevaluate your estate plan, but especially in periods like this where there is a lot of uncertainty, a lot of confusion, it's certainly good to go back and look at and make updates to beneficiaries if things have changed in your will, or if things have changed in your own situation. It's also good to make sure you're communicating with your financial advisor about those changes too, so that we can better help you execute on whatever your estate planning goals are. So it's certainly always a good time to reevaluate those things, and important to have conversations with your advisor about that as well. And with that, that ends our formal remarks. We would love to hear from you. So if anyone has any questions, you can do one of 2 ways. I'll take everyone off of mute here, and you can feel free to just shout out a question, or you can enter the chat room too and take a look and type out a question. So I'll take everyone off of mute. You might have to do it yourself too if you put yourself on mute, but I'll open it up, and if anyone has any questions, feel free.
I just sent John a response there to his question in the chat. You have till year end to make any sort of withdrawal, per se, prematurely from an IRA.
Yep. For those that haven't been able to get into the chat room and they can't see it, I'll just repeat Mr. Neal's question here. He asked, is there a question regarding the CARES Act, the Stimulus Act? Is there an expiration date on the legislation that would create a deadline for making a withdrawal from a 401k or IRA and have it treated rollover? The answer is year end. So you have till the end of the year to make a hardship withdrawal. And then, as Chris mentioned, from there, you have a 3-year period where you can pay back that money, and then it's treated as a tax-free rollover. And if you don't plan on paying it back, they have lessened decreased the tax burden as well, where the taxes are paid out evenly over 3 years. So in Chris's example, if you take out $40,000 from your 401k, you'll have to pay 1/3 of the taxes of that each year for the next 3 years. Now, say you pay the taxes, and then in the 3rd year, you do have money and you want to recontribute that back into your 401k, you can certainly do that. And then that would just require you to work with your CPA or tax advisor in amending the previous tax returns so that you can recoup some of that tax money that you've already paid on hardship withdrawals. Another one come through on the chat. Thanks, Dr. Thomas. Interest rates are crazy low right now, and it's almost a no-brainer to refinance, and the terms products are good. Yeah, I'd agree. I mean, you could see just in the example that Greg used, you know, if you took out a mortgage 10, 15 years ago, there's a real opportunity for savings, especially on interest, massive savings on interest by refinancing. And as he showed too, even if you were to extend the term of your mortgage, you know, say you bought an original 30-year like he showed, you paid it down for 15 years, you could refinance to a 20-year, extend your ultimate mortgage term by 5 years, but still save a boatload in interest. So certainly a good thing to look at if you've had a mortgage for a while and haven't refinanced.
Yeah, and just to kind of even give a personal example there too. I mean, we here in New Jersey originally got I think a 30-year fix at a 4.25, and we were able to take advantage of a modification because it was still a pretty new mortgage and the bank still owned our paper. I think we were able to get like a 2.8 for a 20-year, where after I did the analysis, I was still paying relatively the same amount on a bi-weekly basis. But we were able to pay off our mortgage in about 10 years sooner. So not necessarily a reason that we needed to help on a cash flow, but it allowed us to pay off that balance a lot quicker. So like anything, everybody's needs are different, and I think there's good opportunities based on what's happening in the market right now.
Chris, hold on. Sorry, man. You were on mute. Still on mute. Still on mute. Sorry.
I would comment. I did see a message from people regarding not seeing the same thing with mortgage rates and investment properties. There is a general difference in spread with commercial properties and investment properties. There is a larger usual 0.2 to 1.5 and extra fees in addition to that. So from that perspective, you probably won't see the same thing in the sense of traditional home mortgages for personal use. The banks, I'd say, just from what I've been hearing, are getting a little bit more skittish on some investment properties just as a function of credit in the market. But it's like anything. Shop around. Regional banks, I think, might be a little bit more eager to do some business if you have a good relationship for some investment properties.
Yep, I'd add to that too. Literally just came across that this weekend or this week with a client, and they have an investment property, took out a mortgage a few years ago, got an okay interest rate at I think it was around 4.8, 4.9 through BB&T, and BB&T said if they wanted to refinance, they could only get the rate down to about less than 1%. So they were having the same issues there, where they weren't seeing the refinancing opportunities on the investment property side as much as you can on the primary residential side. I think you're back on, Chris.
You hear me now?
Gotcha.
I've got it coming through the computer. But no, I was just commenting that paying down the mortgage versus investing, a lot of times sometimes it makes sense just to pay that mortgage down and have that sleep a little better at night versus investing. So, but that's a personal situation and conversation to have.
Any other questions from anyone? All right, well, we can wrap up here then. I'll just make again another general plug towards planning. If this environment has you questioning things or unsure about what to do, please make sure to reach out to one of us. I think it's really important to communicate, especially in periods like this. And you know, we can do a lot of really interesting and customized tailor work on the financial planning front. So before making any decisions, it could be really helpful to update a financial plan. If you don't have one existing already, it's a good opportunity to put one together. It is very helpful in gauging your risk tolerance, pre-experiencing what your investment, your future, road of investments might look like. So they are really helpful. It puts things in perspective, and you can make, I think, hopefully better decisions by putting together that plan or revisiting that plan, and not just making decisions based on emotion, anxiety because of an extremely volatile market. So feel free to reach out to any one of us. Happy to help. And again, thanks for everyone taking the time tonight to join us. Hopefully we'll continue to do things similar to this in the future. And again, don't hesitate to reach out.
Thanks, everybody. Thanks for joining.
Thanks for joining us, everyone.
Thank you. Thank you very much.
Thanks, everybody.